housing finance plans, and we will provide a summary of the plan's objectives and touch on many of the key takeaways about the programs. So a little background, this summer, we held an initial webinar on equitable housing finance when the plans were hot off the press. And that webinar actually featured Crystal Cornegay with Mass Housing and Marietta Rodriguez of NeighborWorks America, and our very own George Mac McCarthy here at Lincoln Institute. And it just sort of served to whet your appetite and discuss the potential impact the plans may have. Our webinar today will focus more on some of the specifics of the plan. And we plan this webinar to ensure that conversations about equitable housing finance are not lost and are still gaining traction and have a lot of momentum. After taking more time to look at the plans since the last webinar and discuss many of their objectives, we want to talk today a little bit about their sustainability as well. So this webinar is hosted by the Lincoln Institute of Land Policy, and throughout the webinar, we will also be discussing the Underserved Mortgage Markets Coalition, which is a collaborative the Lincoln Institute is a member of, and you can read more about the coalition on our website. Riley Meave and I are the primary speakers, with Michael Stegman as our featured speaker today in the latter half of the presentation. Additionally, on the back end, and you can both turn on your videos now, we have Jim Gray and Erica Young, two folks who work on our team at Lincoln here with the Underserved Mortgage Markets Coalition, as well as the I'm Home Network. Okay.
Great, thanks. Looking forward to it.
All right, also here are just some basic Zoom house rules we have for this presentation today. So this meeting is first off being recorded, and if you could, please leave your mic and camera off. At any time, please feel free to type in the question and answer box at the bottom of the screen, and we will either respond directly to you or save those for our discussion section later. And as you type, please include your name and your organization alongside your question. Great. Okay, so our starting activity actually is a Padlet activity. And before we begin our presentation, as more folks start to filter in, we want to provide everyone here an opportunity to share your impressions of the EHFPs. And we have two discussion questions to be answered on the Padlet platform. You can access this Padlet here with the QR code or with the link that was just sent in the chat. And you can add your comments by clicking on the plus sign on the website, and then we can see and discuss a little bit about your initial thoughts on the equitable housing finance plans. Yeah, so please feel free to do that. Our first question here is, why are the EHF plans an important step for the enterprises? And the second question is, what is the most important activity for the enterprises to address in their current and or future iterations of the equitable housing finance plans? And so
I'm just going to jump in really quick. Sorry, Daniel.
Yeah.
On my end, I'm not able to send the chat to everyone. So the attendees, I was wondering maybe if Caitlin, our event support, could help send the link to everyone. But obviously you could use the QR code and answer on your phone, but hopefully we can resolve the chat issue soon. All right, thank you so much, Caitlin.
Perfect. Okay, so while you all are typing, just a little more background, we want to emphasize that this is clearly a new program, an exciting program, and there's no clear path for advancing equitable housing finance and reducing the racial homeownership gap. Thus, it's important, we feel, for us stakeholders to have discussions like this Padlet and just sort of uncover what you all are thinking are some of the best tools and strategies to approach these plans. Great. I'm starting to see some of these answers float in here. For the first question, why are the EHF plans an important step for the enterprises? Great first answer here. They're an important step to addressing the racial equity and homeownership gap. Another answer here, ability to preserve and improve smaller multifamily housing communities. A new needed lens. All very exciting and relevant things. So one answer here for the most important activity the enterprises can use to address their current or future EHF plans is to transparently assess progress over time. And that's a big thing that we'll talk about actually later in the presentation. So I'm happy someone brought that up. Great, we'll give you about 1 more minute and then we will move on.
We got some new answers for what is the most important activity for the enterprises to add to their plans. I see involvement and engagement of critical stakeholders, like many of us on this webinar today, and then also energy efficiency. We'll talk a little bit about how some things related to energy are being addressed.
Great. Okay. So I think at this point we can continue on with the rest of our presentation. Thank you all for filling that out. Really appreciate it and good way to get us started. Okay. So our agenda today for this webinar, if you're just filtering in, we've already completed our Padlet activity. And next we will introduce you all to the purpose and process of equitable housing finance planning, followed by a big chunk of the webinar, which will be a thematic overview of the EHF objectives. After that, we will discuss the key takeaways of the program, mainly pertaining to the sustainability of the program and its activities, and briefly touch on how the Underserved Mortgage Markets Coalition, which at times we may refer to as the UMMC, are approaching these key takeaways. Following that, we are honored to have Michael Stegman, a fellow at Urban Institute's Housing Finance Policy Center, here to talk about his understanding of the plans and some of the strengths and weaknesses in the GSE's EHFPs. Oh, that was a great rhyme, sorry. Lastly, we will have a Q&A period, and we want to stress that you can ask questions throughout this webinar. Please put those in the chat or question and answer box. And we are happy to answer those and discuss them a little more later. Okay, so the purpose of equitable housing finance is to advance fair housing and fair lending for all Americans and expand racial minorities' access to opportunities for home ownership and generational wealth building that can come from home ownership in the US. So as described in a 2021 Urban Institute report, a more fruitful way of conceptualizing EHFP is as an overlay that blankets all aspects of GSE policies, processes, and practices, with the twin goals of rooting out vestiges of race-related inequity, such as appraisal bias, while taking bold but prudent steps to close the racial and ethnic homeownership gaps. And we actually have the co-author of that paper on the call today. We must also recognize the outsized impact that the GSEs have had and still do have on setting the terms for the US mortgage lending market. Fannie Mae and Freddie Mac are in a unique position to confront their past discriminatory policies and shape the future of equitable housing finance with these plans. The EHF 3-year strategic planning requirement was announced last summer, And the plans were, or actually, yes, last summer, sorry, not this 2022 summer, the 2021 summer. And the plans were supposed to go into effect on the 1st of January 2022, but were not released until June 8th. The 3-year planning cycle is similar to Duty to Serve, where the plans are created by the enterprises and approved by FHFA every 3 years. And every year, the enterprises must implement their plans and submit annual progress reports on their actions undertaken during the prior year. So, since FHFA has issued no regulation or written guidance of any kind on EHF, the GSE's plans are not organized by defined regulatory activities like duty to serve. And we'll talk more about the implications of that a little bit later. Great. So next up, we will have Riley Meave, also from the Lincoln Institute, describe how the plans have been thematically broken up for our presentation today.
Thank you so much, Daniel, and thank you to all our participants for joining this webinar today. We're excited to be here. I'll do just a quick introduction. I'm Riley Meave. I'm a program assistant at the Lincoln Institute, and I work on a lot of projects related to the Underserved Mortgage Markets Coalition, and I'm also an undergraduate student at Rice University in Houston, Texas. So the Lincoln Institute, in collaboration with the Underserved Mortgage Markets Coalition, defined 10 overarching themes in the enterprise's equitable housing finance plans. So the themes here listed on the slide, they're not defined by FHFA or the enterprises. Rather, this is how we decided to digest and analyze the plans. And the order of these themes also has no significance. We will now do a brief but comprehensive overview of the enterprise's objectives relevant to each of these themes. And the goal of this overview is to ensure the audience here today understands the plans well enough to be able to engage in informed conversations about equitable housing finance. This overview of EHF is not going to be exhaustive, so we really encourage you all to read the plans in full and more detail. And those plans were put in the chat. I will now talk about the first 3 equitable housing finance themes. So first, I'm going to discuss how the enterprises plan to expand access to credit and increase mortgage approvals for Black and Brown households. There are 2 methods that the enterprises are taking under this theme. First, enhancing automated underwriting, and second, improving credit scoring and credit eligibility. Fannie Mae's plans include a goal of implementing cash flow underwriting and automated validation of rental payment history through their desktop underwriter. This action is going to be paired with education, research, and operation changes that will somehow amplify their goals of increasing access for Black credit invisible borrowers. Freddie Mac intends on increasing access to capital for diverse multifamily borrowers. So Freddie Mac plans mentioned wanting to better market to these populations and offering some type of specialized program or offering. As for credit scoring, Freddie Mac notes its intentions to explore alternative credit sources and develop newer versions of underwriting and costing models. This will include integrating cash flow metrics similar to Fannie Mae. Now I'm going to talk about how recognizing the financial and institutional barriers for minority households is the second theme in the equitable housing finance plans. We have identified 4 general objectives listed here that Fannie Mae and Freddie Mac plan to implement in similar ways. The first objective relates to the development of special credit purpose programs, or special purpose credit programs, which we will call SPCPs from here on out. This pyramid SPCPs are at the top because SPC pilots are one of the most significant actionable steps that the enterprises are taking in their equitable housing finance plans. Special purpose credit programs are an important tool for expanding fair access to credit. SPCPs provide a tailored way to meet special social needs and benefit economically disadvantaged groups, including low-income and minority populations. These programs are fair and legal, but they're immensely underused. So Fannie Mae is going to launch 3 to 5 pilots this year, they said, in predominantly Black markets. And Freddie Mac is purchasing existing SPCP loans and developing its own SPCP program. Both enterprises will use these SPCPs to reduce borrower closing costs, increase down payment assistance, and expand loan servicing loan eligibility. The Equitable Housing Finance plans are addressing other strategies that also will attempt to break down barriers to minority home ownership. For example, Fannie Mae is going to launch a first-time homeownership education curriculum, and that's expected to reach like 90,000 consumers, they say. Freddie Mac will explore capping single-family loan level price adjustments through their Home View program for Black and Latino borrowers who have higher credit scores. And Fannie Mae is going to conduct research on the impacts of closing costs for people of color and update their selling guide to encourage lenders to allow borrowers to work around traditional title insurances, but at the same time, they are also going to pilot options to see how title insurance costs may be reduced. Lastly, the enterprises are going to create awareness about down payment assistance programs and just what closing costs look like by developing consumer-facing tools that are going to lead to greater transparency to resources available to Black and Brown households. Now I'm going to discuss the enterprise's approach to loss mitigation. The enterprise's Equitable Housing Finance plans express the importance of improving loss mitigation practices in order to keep minorities in stable home ownership. Here are some key features to the loss mitigation objectives. Fannie Mae will add on features to their SPCP pilots to offer reserve funds for borrowers experiencing unexpected losses in income. Similarly, Freddie Mac will create a viable framework for reserve funds for homeowners in their developing SPCP offering. Additionally, Freddie Mac will improve its servicing in order to strengthen borrower outcomes. Freddie Mac believes that refining automatic payment deferral offerings and implementing it into the SPCP could address disparities in defaulting. Lastly, both enterprises have somewhat vague plans to enhance counseling services for borrowers, which will, at the end of the day, encourage sustainable home ownership. Now I'm going to give the floor back to Daniel, who's going to go over the next 3 key themes.
Thank you, Riley. Okay, so our next segment here is on renter and homeowner financial empowerment. And starting off, Fannie Mae will pilot a rental payment reporting program across the multifamily industry to help Black renters. This comes from their recognition that on-time rental payments are rarely included in credit histories and usually don't contribute to the renter's credit score. And that discrepancy is very big between Black and white consumers with credit histories. And so if the findings of this pilot are productive, Fannie Mae will develop a favorable way to adopt rental payment reporting in their future plans. Fannie will also develop a pilot to defray or decrease the cost of renter security deposits. This is a brand new program, and it will work in conjunction with FHFA's announced plans to mitigate upfront costs for lenders. Freddie Mac is going to support community organizations in varying underserved markets and increase its resource portal for these communities, and that's available via the internet. And this program will begin with 4 community organizations and expand to 7 by the end of the plan period. Likewise, Freddie will programmatically incentivize multifamily borrowers to report on-time rent payments to credit bureaus. And Freddie's already enrolled more than 526 properties in this program and over 50,000 units. And so the preliminary goal for this year is to make credit building available for 100,000 new units. Freddie will also identify and implement enhanced tenant protections. And this was included in the original plans, but it will extend in conjunction with their push for tenant lease protections in their GTS plan updates. Okay, our next section here that we defined is developing formerly redlined neighborhoods. And this was only included in the Freddie Mac EHFPs. And it was designed specifically to help develop formerly redlined and historically underinvested neighborhoods. And so Freddie recognizes that there's a need to preserve the housing stock for Black and Latino renters in historically disinvested communities who are at risk of being pushed out of their neighborhoods and struggling to build wealth. And so by using their develop to developer program, they're intending to spur reinvestment in these communities while at the same time deterring gentrification and encouraging wealth creation. This program will be expanded to include small multifamily property developers and focus on 10 specifically by the end of the plans in 2024. Freddie Mac will provide capital for very small multifamily properties, which are common in underinvested communities, through their small balance loan program under linked loans parameters that finance a collection of small properties. And they will also work with CDFIs and SFIs to finance the hardest to serve communities through leveraging their existing Opt-to-Go network of approved lenders and sellers and actually expanding that network. And so over the course of the plans, Freddie Mac will identify additional Opt-to-Go lenders to commit to supporting these small lending institutions. Another objective that we included through the Freddie Mac plans is creating affordable housing solutions. And similar to the last theme, this is only in the Freddie Mac plans. But one of the goals included in this section is, or many of the goals actually in this section have loan targets, such as 22,000 units of rehabilitated properties in underinvested communities, preserving 10,000 at-risk housing units through rent restrictions, and carrying out at least 6 transactions that qualify as housing for intellectual and developmental disabilities homes. So those are some of the existing loan targets. And they've also committed to a few goals that cannot be tracked through loan targets, such as expanding their TA programs on renovation financing for single family homes in underserved and Black communities, and analyzing the magnitude of their LIHTC property affordability loss and where that's most likely to occur so they can inform their plans in the future when they invest in low-income housing tax credit properties. Okay, and then I will now pass it back to Riley for our last 3 themes.
Thank you, Daniel. Yeah, I'm going to wrap up our summary of the Equitable Housing Finance Plan. So another key theme present among the enterprise's EHF plans relate to appraisal reform. So many of us here are familiar with racial bias being very present in the appraisal process. So both enterprises are identifying a few strategies for detecting unfair undervaluation of homes and preventing undervaluation in the first place. First, both enterprises will expand support for the Appraiser Diversity Initiative, which is something that attracts diversity of housing professionals in the housing appraisal industry. For example, Fannie Mae said they're planning to provide scholarships to students of color to the Appraisal Institute. By leveraging technology and modern home appraisal techniques, the enterprises believe they can create systems to better monitor undervaluation of minority homes. Additionally, Freddie Mac will expand automated collateral evaluation to lower appraisal gaps. Lastly, the enterprises will conduct research to understand the severity and source of appraisal inequities. So another smaller theme, but still significant, is climate risk. Fannie Mae has one objective related to climate risk, and Freddie Mac does not. But Fannie Mae will pilot a climate analytics program, and this is going to help Black homeowners that are disproportionately more at risk for climate changes like increased flooding. It's unclear exactly what those analytics will reveal, though. The last theme we will cover is outreach. Similar to the enterprise's duty to serve plans, equitable housing finance plans have outreach specific objectives. For example, Fannie Mae will undertake efforts to increase Black representation in the housing industry overall. Both enterprises are going to conduct lots of research projects to understand disparities and barriers in housing finance. For example, Freddie Mac's EHF plans already listed 21 projects in the pipeline for the 2022 to 2024 cycle. It's unclear if these research projects were created specifically for the equitable housing finance plans, or these were just papers, research studies that relate to concepts of equitable housing finance that they're already in the pipeline. The last equitable housing finance theme we identified was additional activities that didn't quite fit into a category. We don't have a slide for it, but I still wanted to mention that this additional activities theme includes Freddie Mac objectives for social bond issuance and single family rental market reform. So we really hope this overview of the overarching themes in the equitable housing finance plans was informative, especially for our audience members who haven't gotten a chance to glance over the plans yet. And we hope it encourages you to read over them after this webinar. Before we transition to our conversations about the strengths and weaknesses of plans, I want to remind everyone here to be thinking of questions or comments. You can put them in the Q&A chat at any point.
Great, thank you, Riley. So now it's time to look at the plans with more of a critical eye and talk about some of the major takeaways. So we find it important that you all understand some of the basics to the EHF plans, but we also want to provide you with many of the things that we think are vulnerable and the sustainability of the program. So one of our biggest concerns is that FHFA has not published any written guidance or regulation for equitable housing finance. And changing this is one of the Underserved Mortgage Market Coalition's top priorities. And we actually submitted a letter to Director Thompson about this and met with her last week to discuss this in greater detail. We think that a regulation will not only make the planning process for equitable housing finance more robust and consistent across the enterprises, but also a regulation will promote long-term enforcement of these EHF plans. So without a rule similar to duty to serve, equitable housing finance is subject to political fluctuations as administrations might change. Also, SPCPs are the main tool used by both enterprises to get Black and brown households into home ownership. And SPCPs provide a way for financial institutions to meet the special credit needs and challenges of certain populations impacted by systemic racism, and are completely legal as well. We were happy to see SPCPs heavily embraced by the plans, despite some of the political controversy over the legitimacy of the credit exceptions. However, in a different administration, we fear that SPCPs may lose traction. Additionally, neither enterprise was specific about the scale of their programs. For example, Freddie Mac plans to purchase existing SPCP loans in addition to designing their own program, but no loan target was provided. And Fannie Mae will roll out 3 to 5 SPCPs in predominantly Black markets, but we don't know how large these pilots will be. And again, because this program is so new, we really look forward to seeing many of the plans as they develop and are republished in the spring with some of the initial purchases and objectives completed. So our third point here is that several of the objectives in the 2022 to 2024 EHF plans are pilots. And as we just described, pilots with SPCPs. So we appreciate the enterprises seeing the value in pilots and announcing their pilot transparency initiative. But pilots are sometimes necessary to determine how equitable housing finance can be achieved. And on the other hand, pilots are not guaranteed to be deemed viable investments and or integrated into the enterprise's business models in the future. And so the plans now rely largely on pilot projects in research and outreach. And these strategies are either small in scale or difficult to quantify when tracking the progress in the future. Lastly, there are substantial differences between Fannie Mae's and Freddie Mac's approaches to equitable housing finance. And this, we think, stems from the lack of statutory and regulatory activities that the enterprises must consider. For example, Fannie Mae has an objective relevant to climate risk, as Riley just described, and Freddie Mac does not. The enterprises also understand the mission of EHF differently, and that's definitely shaped their plans. Fannie Mae's objectives are intended to uplift Black households by making steps of the housing journey more equitable. And Freddie Mac takes a broader approach in terms of race and ethnicity and identifies opportunities to redevelop systemically underinvested neighborhoods. In contrast, Fannie Mae's plans have no objectives relevant to community development and affordable housing preservation. It will be challenging in the future to compare and score equitable housing finance progress between the enterprises because the plans are so difficult and different. Okay.
All right, so the last thing we want to present on in this webinar before the discussion period is how the Underserved Mortgage Markets Coalition, UMMC, fits into our discussion of EHF. The UMMC, which Lincoln Institute is a member of, seeks to hold Fannie Mae and Freddie Mac accountable and uphold their founding purpose, which is to bring housing finance opportunities to American families not traditionally served by the private market. And racial minorities have historically been underserved by the enterprises, thus ensuring the sustainability and progress of equitable housing finance is a top priority for UMMC. Although the equitable housing finance plans have been published and set into motion for the 2022 to 2024 cycle, the enterprises have disclosed that they are really open to making changes to the plans, and the program is still in its early stages and malleable. So the UMMC and probably many other organizations on this webinar today are hoping to guide the enterprises and FHFA in a more positive direction for equitable housing finance. We wanted to share some actions the UMMC has already taken or plans to take in relation to equitable housing finance. First, on November 7th and November 8th of this year, UMMC members met with both enterprises and Director Thompson at FHFA. We communicated our support for EHF and advocated for starting a regulation first and foremost. Since then, members of the coalition have been asked by the GSEs to advise them on how to best fulfill their equitable housing finance plans. We will continue to have regular discussions with both Fannie Mae and Freddie Mac in an effort to ensure the enterprises are meeting their mission. Also, FHFA announced the creation of a federal advisory committee on affordable, equitable, and sustainable housing. Although we have yet to see the official charter and application process for this committee, it's an exciting step and clear choice by FHFA to support affordable housing expansion in the United States, which aligns with the values of the UMMC. FHFA is expected to release more information on this soon, and once they do, we at Lincoln will release an asynchronous webinar about how this committee will work and its significance. All right, so we're now entering our discussion portion of the webinar. As we mentioned in the agenda, we're first going to hear comments from Michael Stegman, and then we'll answer questions or respond to comments from the audience. So Michael Stegman is a non-resident fellow at Urban Institute's Housing Finance Policy Center, and he spent a lot of time evaluating the enterprise's equitable housing finance plan. So we're really lucky he's here with us today. Before Michael offers some valuable insight into the enterprise's approaches to EHF, we want to highlight a recent policy brief he and some other colleagues wrote about our webinar topic called The GSE's Equitable Housing Finance Plan, Strengths and Missed Opportunities. And a link was just sent in the chat. Michael, thank you so much for joining us again. The floor is yours.
Great, thank you, Riley, and thanks to Lincoln Land for inviting me to participate in today's webinar. Let me begin by noting that the GSE's equitable housing finance plans are works in progress. And while they have a long way to go in spearheading the effort to right historic housing policy wrongs directed toward people of color, we should not underestimate the importance of these new beginnings. The GSEs should lead the way forward because they are responsible for funding more than 1 out of every 2 home purchase loans in the country. And their policies and practices set the national standards for the housing finance system. Their inaugural plans do an excellent job of diagnosing the federal role in generations of discriminatory housing policies that have helped create and perpetuate unacceptable racial homeownership and wealth gaps. However, neither GSE gets a passing grade on introspection and self-reflection. While both plans identify the pain points and frictions facing houses of color in their homeownership journeys, neither explain their historical roles in perpetuating these systemic problems. Why is it that less than 5% of GSE purchase money loans went to Black borrowers in 2020, compared to 7.5% of all purchase loans market-wide, and more than 16% of all FHA loans? Does the problem lie in pricing, product mix, lack of diversity among GSE seller servicers, underwriting, or a combination of these and other factors? Being excruciatingly self-critical and transparent at the front end of the equitable housing finance planning process is a must. As Daniel indicated, before the planning process got underway, my Urban Institute colleagues and I advised FHFA that it would be short-sighted to treat the GSE EHF requirements as just one more siloed plan alongside their affordable housing and duty to serve obligations. We argued that it would be more appropriate to conceptualize equitable housing finance as an equity overlay that should permeate all aspects of GSE policies, processes, and practices that would make advancing racial equity a primary business objective. In that spirit, we offered FHFA 3 core principles that should guide the EHF process. First, establish a clear vision and goal for equitable housing finance based on a few focused goals. Second, operationalize equitable housing finance with clear and quantifiable objectives. And third, align reporting systems and structures around the equity objectives. We also reminded FHFA that because the EHF process lacks statutory or regulatory authority, as Daniel indicated, the next administration and FHFA director could wipe it away with a stroke of the pen. Embedding equity enhancing efforts into the GSE's structural DNA and business models would have the added benefit of protecting the EHF process over time from dramatic pendulum swings due to changing political priorities. And as my colleagues and I reviewed the plans, we find lots of good, some bad, and some missed opportunities that we discuss at length in our October policy brief. Let's start with one of the very goods, which is both GSE's support for special purpose credit programs. Although the legal framework for SPCPs has existed for decades, mortgage industry adoption is still tentative in its early stages, despite official guidance and support for SPCPs from the CFPB, from financial regulators, and from HUD. Two impediments to wider adoption that the GSEs could mitigate are originators' liquidity concerns stemming from uncertainty about secondary market acceptance and the lack of standardization. Fannie and Freddie's embrace of SPCP loans could go a long way toward making them an accepted product. However, the likelihood of widespread originator acceptance will be higher if an SPCP loan that is acceptable to one GSE would also be acceptable to the other, which currently may not be the case. Because of their outsized role in the housing finance ecosystem, SPCP standardization and alignment by the GSEs would have the added benefit of implicitly becoming a national standard and safe harbor that would resonate positively throughout the industry. In this regard, we are encouraged by Fannie Mae's intention in the coming year, and I quote, to, as appropriate, work with FHFA and Freddie Mac to develop standardized GSE SPCP programs, close quote. On the bad side, we point out in our brief that neither GSE plan provides a clear rationale as to what activities belong inside their EHF plans and which do not. So let me conclude my remarks with 3 examples, starting with the complicated and sprawling issue of the effects of climate change on mortgage finance. Now, there's a burgeoning literature that diagnoses how various risks from climate change are likely to stress the entire mortgage finance system, including the GSE's abilities to distribute and manage risk. And as one recent report indicates, and I quote, although the GSEs currently shift some risk of losses to private investors through credit risk transfer securities, higher default risk due to climate change may cause investors to increase prices or exit the market, close quote. So Fannie Mae's proposed pilot to develop climate analytics to help prepare Black homeowners with increased risk of climate change seems to me to be clearly a case of the tail wagging the dog. This valuable exercise should be part of a larger and more comprehensive Fannie and GSE climate change agenda in which the special challenges posed by climate change to families and communities of color should be part of those larger business-wide evaluations and assessments. My second example of what's in and what's out concerns the GSE's EHF efforts to enhance homeownership preservation that Daniel and Riley summarized through more robust post-purchase education and counseling, helping borrowers buffer economic shocks, and creative special servicing loss mitigation reforms. These proposals have great potential to advance equity because Black, Latino, and other non-white borrowers are more likely than white borrowers to experience financial hardships that impair their ability to maintain payments. However, given the fragile foundation of EHFPs and their real risks that SPCPs will never scale, these equity-enhancing actions should not be limited to special purpose credit program loans, but incorporated into the GSE's respective seller servicer guides more broadly as part of the mainstream single-family lending business lines. The same can be said about FHFA's rethinking the role of upfront risk-based pricing fees, more commonly referred to as loan level price adjustments, or LLPAs. While the equity implications of reforming the current LLPA regime are incorporated into the GSE discussions of loans made within the narrow confines of special purpose credit programs, FHFA recently announced, correctly in our view, that it would be eliminating LLPAs on a broad range of first-time homebuyer and other mission-driven LMI loans without regard to whether they are originated under an SPCP. And as we advised FHFA, the what's in and what's out confusion could be resolved by conceptualizing and operationalizing the EHF process as an equity overlay that permeates all aspects of GSE policies, processes, and practices. So to close my remarks, I will note that neither plan considers the relationship between the GSEs and the Federal Housing Administration, or FHA. This is unfortunate since some of the items proposed in their equity plans might simply move loans from the FHA to the GSEs. Although this would reduce mortgage costs for some borrowers, the moves would only have a marginal effect on overall increases in access to credit. It would have been valuable if the plans enumerated which creditworthy borrowers are missing from the system and the hole in the market the GSEs are trying to plug with their equitable housing finance plans. And with that, I will turn it back to Daniel and Riley. Thank you very much.
Thank you so much, Michael, for provoking such an interesting conversation about equitable housing finance. Now we invite the audience to ask questions to Michael, to ask questions about Daniel and I's presentation. You can also provide a comment you'd like to share if you have some observation about the equitable housing finance plans. We'd love to hear those if they are something different than what we shared today. So we already have some questions popping up, so we can start to answer those. So Kate Ostermiller asked, are there ways to contribute to policy advancements for equitable housing finance at the community level? How can ordinary people interested in this become more involved? That's a great question that I think we don't ask enough, looking at the enterprises at a national level. So I don't know if there's a perfect answer to that, but I think it's really important that the enterprises engage with stakeholders at the local level to make sure that the actions they're taking to advance opportunities for Black and brown households, people actually know about at the local level. And so that was something shared on the Padlet we did earlier. That's really important for the enterprises to engage with the community and stakeholders. So I just wanted to reiterate their comment.
Great. Thank you, Riley. Another question here actually is addressed to Michael, if you're able to answer this question. So this webinar called out several objectives that the EHF plans are not tackling. Are there any unnecessary measures in the plans? And are the plans too ambitious in some areas?
I think I would argue, as I suggested, I think in my remarks, that the GSEs ought to be concentrating on kind of fewer activities. You know, one of them has 17, and it depends on whether you count sub activities and so on, but there's kind of a scattershot kind of nature to these programs. That's why I picked out climate change, and there are a couple of others in which it would be much better for the GSEs to tackle things like climate change and address some of the disparate impacts and racial impacts of climate change, the disproportionate burdens within those broader work streams, rather than packing it into an equitable housing finance plan. I think a good example of system-wide efforts are the underwriting efforts to incorporate rental and cash flow data into broad single-family underwriting, in which case borrowers of color who might be able to document a broader portion of their kind of economic lives through their bank account cash flow data, through their residual income data, through rental payment data, that will disproportionately benefit those with thin credit files and so on. But it applies broadly, not just to a narrow slice of lending based on special purpose credit programs, or whether it's in their affordable housing plans. So I think you want to have more focused, deeper commitment of resources and potentially scaling pilots more, and developing assessments that allow you more quickly to bring positive pilots into the mainstream kind of businesses. There's also Richard Koss, I see, speaks to the issue of lack of, legislative standing for these equitable housing finance plans. We mentioned in our policy brief that while you can't protect equitable housing finance plans from a change in leadership, putting them into regulatory form makes it certainly a little more challenging to eliminate them. Treasury and FHFA have the preferred stock purchase agreements, the contracts between Treasury and FHFA that really control the taxpayer support for the GSEs while they're in conservatorship, and you can modify those and incorporate more equitable housing finance concerns in those contracts. And it then would take both agreement by the director of FHFA and Treasury to modify those. And in a divided government, it might protect the EHP process a little longer.
We have another question for you, Michael, if you'd like to answer, by Sharon Cornlison. Love to hear more commentary about SPCPs simply shifting buyers from FA8 or FHA to this loan product. What would you suggest would be more of an effective way to expand the pool of eligible Black home buyers instead?
Yeah, it's a great question and a real important issue. We don't have a history of coordinating policies, pricing, and programs across the GSEs and across FHA. There is an advisory board that advises the FHFA director called the Federal Housing Oversight Board, which includes the Secretary of HUD on that board. And that organization or something else, whether it's coordinated by the White House or other body, could really begin to explore the role that FHA and the GSEs ought to be playing in the affordable housing kind of landscape. You've got conforming loan limits, you've got pricing, you've got policies dealing with down payment assistance. All of these things ought to be kind of consciously discussed about how you can expand the kind of credit pie rather than simply having competition based on whether FHA reduces its mortgage insurance premium or FHFA changes its upfront loan level price adjustments. So I think more coordination, more conscious coordination is both possible and desirable.
Great. Okay. Well, thank you so much, Michael and Riley. I think we've run out of time to answer more questions. But before you all go, we want to end with one closing poll question. And we thank you for joining us today. Our closing poll question is, do you think the equitable housing finance plans are robust and sustainable? Thanks again for joining in.
Yeah, thank you so much for joining. Once you answer this question, you're free to leave. We just wanted to leave this question in your, it'd be the last thing you think about in this webinar. We want you to leave thinking about this. And thank you so much for joining, everyone. Interesting. We got quite the normal distribution responses.